Markets are flat ahead of Jackson Hole. Thailand's growth slows as tariff and political dramas hit. India gets a long-overdue credit rating upgrade. And there's another sign of life from New Zealand's economy. That's coming up in our 5 Things in 5 Minutes on Tuesday, August the 19th. And in part 2 of a deep dive interview with ANZ senior China strategist Zhaopeng Xing, he details how China is shutting down price-cutting wars to cure deflation, including by banning cheap power banks from planes.
The government measures look smart. It just elevated the safety standard. So finally, the market goes back to normal.
But first, in 5 and 5 with ANZ, global markets were largely flat overnight. They're waiting for news from Fed Chair Jerome Powell. He's due to speak later this week from the Jackson Hole Symposium of Central Bankers. Here's ANZ Head of G3 Economics, Brian Martin, on why that's important.
One thing I think that we're going to have to watch very closely coming up is the Jackson Hole Symposium that starts on the 21st and runs to the 23rd of August. The theme for this year's conference is labour markets in transition, demographics, productivity and macroeconomic policy. It's very pertinent given the clampdown that we have had on immigration recently. It's very pertinent given the slowdown that we are seeing in hiring as well. So it will really provide a stage for Fed Chair Powell to outline his thinking on the labour market and what the appropriate macro response or interest rate response is to it.
As of 4 a.m. Sydney Melbourne time, the S&P 500 and the Nasdaq were flat. The 10-year US Treasury yield up 1 basis point to 4.34%. Gold down 0.2%, $3,377 an ounce. West Texas oil futures up 1.1% to $62.69 US a barrel. The US dollar index up 0.3%. That meant the Aussie dollar fell 0.3% to 64.91 US cents. And the Kiwi was flat ahead of tomorrow's rates decision from the Reserve Bank, flat at 59.22 US cents. Number 2, Thailand's GDP growth eased to an annual rate of 2.8% in the June quarter, and momentum is waning, says ANZ economist Crystal Tan.
Now, looking ahead, growth is expected to slow more sharply in the second half. The impact of higher US tariffs, now at 19%, will weigh on external demand. Thailand also remains highly exposed to redirected trade flows. Meanwhile, domestic demand is under pressure with high household debt, tight credit conditions, and weakening consumer confidence. Tourism continues to struggle, with arrivals down nearly 16% year-on-year in July.
Number 3, Thailand's economy won't be able to rely on much help from policymakers, Crystal says.
Now, on the policy front, fiscal support will be modest. Although the fiscal year 26 budget bill has passed the House, spending is only up 0.7% year-on-year. Some targeted stimulus remains in the near-term though, including packages for infrastructure, tourism, and sectors affected by tariffs. On the monetary side, we see room for at least one more 25 basis point rate cut this year, and that would bring down the policy rate to 1.25%.
Number 4, India's sovereign credit rating has finally been upgraded to BBB from BBB- after a wait of 18 years. ANZ economist Diraj Nim says many think it was long overdue.
The last 3 to 4 years, India has shown commendable fiscal restraint despite staring in the face of economic crisis due to the pandemic. And at the same time, economic growth has sustained momentum. For the last 3 years up until FY25, growth averaged over 7.5%. So I think that they were largely overdue, the rating upgrade, but it comes at an interesting juncture because when we're looking ahead for these key parameters on which the rating upgrade was predicated, growth seems to be under some stress because of the external demand risk and also the fact that domestic demand indicators have softened.
Number 5, New Zealand's Manufacturing Purchasing Managers Index rose in July into expansionary territory, while its Services Index also improved, although it remains in contraction mode. Here's ANZ economist Matt Galt on the New Zealand economy's trajectory this year.
The New Zealand economy picked up a bit between the December and March quarters, but then it really stalled over Q2 with a broad-based deterioration in the high-frequency data. A couple of things could be behind that. Partly it could have been tariffs and the flow through to the New Zealand economy. Partly it could be rising prices for necessities as well, pressuring household budgets, with food prices having increased quite a bit between the start of the year and now. But one way or another, it looks like we might be past the peak period of pessimism now, with a few indicators looking somewhat better, though it's hardly strong, and would need to see more of an improvement from here to keep medium-term inflation stable.
Matt Galt there. Now, in part 2 of today's deep dive interview, ANZ senior China strategist Zhaopeng Xing details how China is shutting down price-cutting wars to cure deflation and whether it'll work. Remember yesterday Zhaopeng introduced us to the idea of involution, to curl inwards, talking about those price wars and how the government has shut down a price war in food delivery by simply ordering the companies to stop. And what are some other good examples of anti-involution policies cited in the official media?
Another very popular example often cited by the official media is the power banks. China has restricted to take uncertified power banks on flights. It makes because some power banks can got fired even on plane. So the government put very strict restrictions on their usage, and also the government has elevated the safety standard, technical standard for the power banks. I think it has cleared up the market. So currently, I think the power banks price may be higher, but the consumers can have very good assurance for their safety in different places. I think this is a good move. It also signals that the government has no intention to cut the capacity by administrative measures. I think the government measures looks smart. It just elevated the safety standard. So finally, the market goes back to normal.
Another way to solve this gap between demand and supply is to increase demand. Why couldn't the government do a massive demand stimulus program to solve the problem?
I think the biggest hurdle for the government to do so is macro leverage level. China household already indebted, so the debt to GDP ratio of the household, I think, is close to 60%. So this is already very low. So given this very high leverage in households, I don't think demand side support to the household can be very effective. So any consumption or domestic demand stimulus will be mild, not bazooka-style stimulus.
Do you think that these anti-involution policies will be able to stimulate prices and return China's GDP flater to being positive?
I think so, but the path can't be very smooth because of the lack of very effective demand side measures. So we still expect the PPI inflation to stay negative this year, but we see PPI to turn positive early 2026. For GDP deflator, there is also a good chance to turn positive next year because China GDP deflator is evaluates the price level against 2020. So next year, China will change the base year for real GDP calculation from 2020 to 2025. I think this change will give a very favorable low base for the GDP deflator. If you look at the China GDP deflator, in the history, I think every 5 years there is a uplift in the GDP deflator. China has been in very deep deflation in the late 1990s, but in 2001, I think China GDP deflator turned positive. It also happened in 2011 and also 2016. So next year, 2026, I think China GDP deflator will turn positive if the base year changed to 2025.
Zhaopeng Xing there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, August the 19th. Catch you tomorrow with a preview of the Reserve Bank of New Zealand's expected rate cut. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.